Now, condo corporations are often focused on three key things when looking at an investment strategy. One is making sure that they have ongoing access to cash and flexibility to access it for whatever needs arise. Two, when rates are going up, as they are right now, they want to make sure that they have the ability to participate in rising interest rates. Because absolutely, why would we lock in something that is lower than what we could get? There's an opportunity cost there, and we want to be able to keep up with inflation and costs as much as we can. Thirdly, how can we keep capital safe? We don't want to gamble. We want to make sure that we have funds protected under our deposit insurance rules. So how can we do something that's safe, gives us flexibility, and again, has some return that is more than zero, but again, with that trade-off of not taking on too much risk. So this is the type of investment planning where we can add the most value. We do it by looking at the condos reserve fund study, and make sure that based on which cash is needed and when, we ladder those GICs or bond investments. And we can stagger them so that those investments will mature and align with when that cash is needed to generate more consistent returns and give the condo corps flexibility to access that cash, but not have to leave it sitting uninvested for 2 years. Say if you know something needs to be replaced in 2 years, instead of just leaving it there to sit, you could put it into a 2-year GIC or a 1-year GIC. And that's really where that planning piece is so valuable, because we have the foresight to be able to know with reasonable certainty what is needed and when. The example of that is if we were to say, look to buy, say we had $500,000, instead of buying a $500,000 5-year GIC, if in that example, that's when the cash is needed, or the majority is needed, what we would do in this case is buy, for a simple example, 5 1-year GICs at $100,000 per instrument. So we would stagger them out. And I'll show you on this next slide how we can do that in order to get better yields and less reinvestment risk while having more flexibility. So this is a laddering strategy. As you can see here, this there's an instrument at 3.25% that after 365 days will have matured, and that 100,000 then gets reinvested at the back end of the ladder, the last rung, at 4.75% for a now 5-year investment. And every year thereafter, the way this is structured, you'll have cash maturing. And so again, just a simple example, it's not always, doesn't always work out to be even numbers this way, or even consistent tenors or time horizons. But in theory, this is how it works. And this has been a really powerful tool that we like to use with our condo corporations. Now, there's always an asterisk. GICs are, in fact, they're low risk, but not risk-free, because there's no such thing as a free lunch in finance. The reasons that GIC are low risk is because we are pretty much assured, we're assured that if you were to invest in a TD GIC, we're pretty sure that in a year's time, TD will be able to repay us our money. They're not going to go bankrupt. If they go bankrupt, we have bigger things to worry about. In 1985, a couple of Canada's big banks, I shouldn't say big, a couple of Canada's banks did in fact fail. The Canadian Deposit Insurance Corporation, or CDIC, now was established to insure up to $100,000 per investor for each institution. So we want to make sure that while we want to be aware who we're buying from and how much, the real key thing to be aware of is making sure that we are not, for certain institutions, that we're not going above that $100,000. If you're looking at the big 6 banks, the TD, CIBC, Scotiabank, National Bank, RBC, it's probably safe to say that in this time horizon, that those big banks are, because of their strong credit risk, they're not likely to fail. However, there are some alternative lenders that, because of the nature of what they do, i.e. providing risky or say unsecured, stretchier loans to those who might not otherwise qualify with the big 6 banks, because they're providing some alternative lending to certain customers, they they need to raise deposits. And that's often why they have higher deposit rates to attract capital. Spring is actually a very big time. Mortgage lending, people are out buying houses. And so you'll see a lot of these alternative mortgage lenders. Home Capital is an example, Home Trust is a name they go under. You'll see them have attractive rates. You'll see them really trying to get deposits because they want to be able to lend into that mortgage market as more people are buying homes in the spring and the summer. So all to say, the big takeaway here is even though the CDIC is around, and even though we don't think that lending institutions can fail, it does happen. Like in 2017, with these headlines from Home Capital, which almost went bankrupt, and individual investors would have lost anything they had with them over $100,000. That's really important. So make sure that when you're buying from a riskier lender, limit it to $100,000. So I want to show you here that these are recent rates on GICs, and just a summary of a couple of the issuers from who we can access. It's not just Scotiabank products. So this is a really important point. We have the ability to pull up these rates and say who provides us with the best rate over which time periods, and be able to cherry pick that way. As you can see, Scotia doesn't have the best rate for years 1, 2, 3, through to 5. So why would we incentivize our clients to necessarily have to invest in our 2 or 3 year? We would generally go to another issuer in order to make sure that we're getting the best returns. What I also want to highlight, and actually the column on the right here, the DBRS rating, that's a credit rating of the institution. So the AA would be the strongest, and then it generally goes down from there. The Bank of Canada interest rate hikes. Now, I know some people might think that come June, if the Bank of Canada were to hike rates by a 0.5 percentage point, that it's likely that, in this example, the Bank of Nova Scotia 1-year GIC would increase from 3% to 3.5%. But that's not necessarily the case. While there is generally some correlation, the rates don't directly correspond. And that's an important point. Interest rates in the market are generally, they reflect interest rate expectations. And when you see here how, from years 2 to 5, the alternative lenders, those who are big into the stretchier mortgages, let's say, the reason their rates are more attractive is because they need deposits more, and they're willing to pay more to an individual to purchase a GIC from them in order to incentivize that. And just another slide here to show how this could work in theory. So purchasing, say, a 1-year GIC from National Trust Company, 2 years from Equitable Bank, and a 3-year from, say, B2B or Concentra, and we can stagger them in that sense.